Hey, what's going on, cash flow hackers? It's Chris with Life 180, and today we are talking about the 7 ways to create wealth utilizing life insurance, whole life insurance specifically. Now, did you know that whole life insurance is about way more than just protecting your family in the unfortunate case that maybe you're not here anymore? It can actually be utilized as a financial tool to help you create wealth as you go through life. In this video, I'm going to talk about the 7 ways that I find are the most commonly used and the most powerful that people utilize while they're alive to enhance all the areas of finances in their world. So let's just jump right into it. The first way is that we can leverage the cash value as an investment. Now, one of the phrases that I use very often is that we need to save money first. We need to save money, not just to save, but to invest that money. Right? So when we save with the purpose of investing. And so when we save money inside of a whole life insurance policy, the cash value grows over time. It's going to go up in value. And as that cash value goes up, you can leverage it and you can basically have a line of credit according to the cash value to invest in things like real estate, business. You can do private money. Those are my 3 favorite areas to create wealth. Now, leveraging the cash value in your policy to create wealth is one of the most powerful things that you can do. Now, the second way that whole life insurance can help you create wealth is by giving you tax-free growth. One of the greatest interrupters of your growth, maybe you don't realize this, is taxes. For instance, if you go into a savings account, I'm going to show you this here. If we go into a savings account, and let's say you have a high yield savings account. And I get this all the time right now because some people are saying I could just put money into a high yield savings account. You know, whole life right now is paying a 5.2 to 6% dividend. Well, if I could just go, then you got to say net that out after all the cost, mortality charges and all that stuff. You're looking at probably 4.2 to 4.7%. would be the net of everything. So if I could just put money into a high yield savings account and I could earn in that savings account 5%, well, then 5% is going to win. So there's a couple things at play here that we need to consider. The whole life, this number is going to be more predictable. For instance, the 5.2% is the lowest that we've had for a dividend rate in about the last 80 years. And so when you take that into consideration, you look at the 5% in high yield savings account, that's the highest it's been in decades. And so not only that is that this 5.2 grows tax-free. This 5% grows on a taxable basis. So for instance, if you had $100,000 inside of a savings account earning 5%, that's $5,000. You're going to get a tax bill for this $5,000. You're going to have to pay tax on this money. If this whole life grows at let's say 4.7% at 100,000, you might not have 5,000, you might have 4,700 on the whole life side. So a lot of people are like, why would I ever do the 4,700 when I can get 5,000? Well, because you're not going to get a tax bill with this money. You're going to get a tax bill with the $5,000 to whatever tax rate that you're dealing with. So that's something to take into consideration right there when you're going through this. So the third way that whole life insurance helps you create wealth is by giving you safe and guaranteed returns. There are not a lot of financial products in the world that allow you to even mention the word guaranteed. Most investments that you're talking about come with a function of risk. That's one of the reasons I can't stand when a lot of people try to compare whole life insurance to other investments. They don't have the same risk profile. Whole life insurance and annuities, I guess, are pretty much the only products in the financial industry that allow you to mention the word guarantees in it, right? So when we're comparing a product that offers a guaranteed return versus more speculative investments, of course, we're not going to have the same upside potential in a guaranteed return product. In fact, that guaranteed return product, is not designed, it's not there, it's not involved in your financial life to help you create that crazy wealth and to take that risk to get those returns. Now, I'm not saying that you don't need to take risk and make investments, whether it's real estate, business, doing private lending, investing in the stock market, other things of that nature. I'm not saying you don't need to do that, but I am saying that your financial structure is important, that you need to build a foundation of financial stability, and that financial stability better come with guarantees and guaranteed growth, right? Like, because that is going to be the foundation of what you build on, and it's going to ultimately, the bigger and the stronger your foundation is, the more you're going to be able to take risks outside of that to go and build wealth. You're not going to build wealth inside of your life insurance policy, inside of your whole life policy. You'll build wealth, it'll just build slower, but you will build wealth outside of the policy because of the fact that you have it there. It's something that having the policy is going to enhance your ability to take more calculated risks outside of the policy. And that leads me to number 4, which is the fourth way that whole life insurance helps you create wealth is by utilizing it as tax-free income in retirement, by utilizing it as a volatility buffer. One of the things Tom Wall, who wrote, he's a PhD in retirement income, he wrote a book called Permission to Spend, and he talks about the fact that by having whole life insurance policy as a volatility buffer, it goes back to what I was just speaking. Whole life insurance may not be the sexiest of returns. It's going to get you bond-like returns over a long period of time. However, what it will do is that by having that policy there, it's about helping your other assets perform better. If you have the whole life insurance policy in retirement, then you have your other assets, your other investments that are giving you your cash flow on negative performing years, which is going to be about 30% of the time. You're going to be able to tap into your whole life insurance policy for the tax-free income that you need, not forcing you or allowing you to not have to tap into your negatively performing investment accounts. We all know that the worst thing you can do is tap into a negatively performing account, because when you sell off an asset that just lost money, you lock in that loss, and that has a compound effect on the potential of your account to recover. And so by utilizing a volatility buffer, it's saying don't liquidate negatively performing assets, utilize the whole life insurance policy on negatively performing years, allow those other assets to recover. And what this does, by having this asset in place, it may not be the sexiest thing, but what it's going to do is it's going to allow those other investments to perform 25 to 50% better over a long period of time. That creates wealth, even if you can't see it. This is why financial structure is so important. Now, the fifth way to create wealth through whole life insurance is through estate planning and wealth transfer. Now, this is the obvious one. This is what most people think about, but I don't think we can go through a video talking about this topic without talking about the importance of utilizing whole life insurance as a wealth transfer vehicle. Now, a lot of people will say, I don't need whole life insurance for my whole life because I can buy term and invest the difference. By the time I'm 65, I should have enough money. I can self-insure. Well, I got news for you. You cannot self-insure, because if you self-insure, that means you basically take away your ability to spend in retirement. Like, I mean, I guess you could spend it down to zero and that's okay, and leave nothing to the next generation. I just come through the belief and look at things through the lens that I believe it's our responsibility to leave the next generation with more than what we have. What I love about whole life insurance is not just about passing on an inheritance, it's about passing on the heritage of what we want to pass off from a financial principles perspective. What do you stand for? What do you want to teach for habits when it comes to saving, when it comes to giving to charitable organizations, to giving to our communities, to just taking care and having financial systems built to be able to grow the impact that our families have to be able to make in this world. And you know, we talk about this a lot in what the Rockefellers book do. That I just wrote the foreword and worked with Garrett on this, and Garrett Gunderson on this. And when we talk about what separates the Rockefellers from other families like the Vanderbilts, was their ability to really think long term and have that long term vision, and realize like time and compounding is a powerful thing. If we can transfer wealth from one generation to the next in the most tax efficient way, then that enables us to compound that growth. Now, if we can do that and teach principles and systems and rules and use trusts and things like that, I'm getting a little off topic with it all, but it's all still on topic. I'm expanding on this a little bit more than I had planned. But if we do that, then we're putting ourselves in a situation where our family can truly succeed and thrive generationally. Now, there is no better asset in the world to utilize for wealth transfer on a tax advantage basis, tax-free basis in most cases, than a whole life insurance policy. Now, the sixth way that whole life insurance can help you create wealth is by protecting you from financial emergencies. By having your cash value in your whole life insurance policy, that money should operate also as an emergency fund. Now, a lot of people will think you should have your money in a savings account for your emergency fund, but I will tell you that a real emergency is really not, do I need to fix my air conditioning unit? Do I need to make my big car repair? Did I lose my job for 4 or 5 months or something of that nature? A real emergency is something like becoming critically, chronically, or terminally ill, something like losing 2 of 6 daily living activities, or getting Alzheimer's, or getting diagnosed with a terminal illness like cancer. Being able to access the death benefit while you're alive to deal with those things, to help manage your bills, use that death benefit to keep your dignity, pay for in-home care, do things of this nature. This is what it's all about. It's about having options. It's about having control. And if you are able to have access to tax-free money to handle those real emergencies in life, well, then it can protect you from making bad financial decisions, or to take on, keep you from, or help you avoid having to take on high interest toxic debt that comes with extra strings attached, extra fees and costs. A lot of 27, 28%, even 30% interest rates I've been seeing from some people recently, who have leveraged loans for paying for things like car repairs and like air conditioning units and stuff of that nature. So by having an emergency fund inside of a whole life insurance policy, it helps in those areas. And that leads me to the seventh and final, and what I think is one of the most important fundamental elements of a whole life insurance policy. The seventh way to build wealth is that it helps you to increase your financial efficiency. Now, financial efficiency to me is simply getting your dollars to perform more effectively and getting more out of each dollar that you have at use, right? And so what I think about in this way is, like, the market is going to shift, and I want to actually go to the board here, and I want to show this because as we look through life and as we go through life, you'll see that the market is going to shift as we go through, right? So, for instance, like the interest rates. If we look at interest rates here, the market is going to go up and down, right? And so the highest rate back in the 80s was 19% for the federal funds rate, and it's been all the way down to 0%. This is obviously not the scale, but what happens is in increasing interest rate environments, going to banks, lending tightens up, so banks tighten, and you can't access money. Interest rates increase, right? When they increase, the cost of money goes up. So if cost of money is going up, this is where the power of having money in a whole life insurance policy, when all this is happening in this increasing rate environment, now we have efficiency, because rather than using a bank, now we can utilize our whole life cash value, right? That's what we're doing. We're supplanting that, and we have more access. And when banks are tight right here, when banks are lending tightly, well, and you don't have to jump through hoops to get cash value, typically when banks tighten, that means asset prices go down, and that creates more opportunity for people who have access to capital. And so you can get better returns with less risk, and that is the power of having this. Now, on the flip side, what's going to happen is we look at this when interest rates are going down, which if we look, from 1980 to 2010, effectively, interest rates were going down. In that reducing interest rate environment, what happens is we have the ability to build in arbitrage. So if I could show you how to go into your policy, and you could have 6% return in the policy, we'll say a 6% dividend in the policy, and then you could use a cash value line of credit, collaterally assigning, I'm using big words, but assigning the cash value in your policy to a bank to get a 3% to 5% line of credit, well, then we could build in between the, say, 5% and 6% dividend here, we could build in a positive arbitrage spread. And so this is a way to create wealth and leveraging money in a better way. Either way, if whether rates are going up right here, and I access money in my whole life policy, and let's say the banks are lending it at 8%, and is the bank, and I could get money out of my whole life policy at 6%, then there's a 2% efficiency, and that comes at a lot of money saved. And anytime you save money, you create wealth. And this is the thing. A lot of people, this is the thing that I fight with wealth managers. They always talk about you need to go out and chase big rates of return. No, you don't. You need to operate more efficiently and understand how to structure your life to be able to save money to create wealth, because every penny saved is a penny earned. We've always heard this, right? Now, this is, the ability to control what I would call the cost of capital, right? We're controlling the cost of capital with that 6% compared to an 8% bank loan. Now, in the future, we're able to do the same by leveraging a bank. Now, when rates are going up, what we're doing is we're using the whole life instead of the bank, right? We don't want to use the bank, but in decreasing interest rate environments, we're going to go to a bank and we're going to leverage that bank. We want to leverage the cash value line of credit in the bank, and that's what we're going to do. And instead of utilizing the policy loan provision, we're going to use a collateral assignment to the bank and get a lower rate and build in positive arbitrage in that loan, and then we can leverage this to go out and invest in other things like we talked about. We could then go back to number one here, and we can use the cash value for other investments, right? And by having the money in the whole life policy, we're going to beat the savings rates of banks, and we're going to get the tax-free growth, right? From a long-term perspective, that's going to come. We're going to have safe and guaranteed returns, which mimic bond-like returns. So it's going to be savings-like liquidity, money market-like liquidity, and we're going to have guaranteed returns that mimic more of the bonds. We're going to have the volatility buffer for retirement income to make our other assets and our other investments perform 25 to 50% better. We're going to have the most tax-efficient way to pass on money to the next generation for wealth transfers to help do what the Rockefellers would do. And I've got a lot more content on that coming out. So if you're interested in learning about that, make sure you subscribe and hit the bell that we're notified every time I launch a new video. Click on that bell below. And then we're talking about everybody needs an emergency fund. This is the foundation of your financial life. If you're not protected against financial emergencies, you're never secure. If you're never secure financially, you're never really an investor. You're just a speculator, and speculators get massacred eventually. Don't speculate, be an investor, have a system, have a good financial structure set up. And then at the end of the day, as I've shown, by having whole life insurance, it's going to enhance your overall financial efficiency, leading to you reaching your desired goals with more predictability, right? That's what it's all about. So hopefully you found value in this. Hopefully that makes sense. If you haven't already, once again, make sure you subscribe and hit the bell that we're notified every time I launch a new video. Any questions, comment in the comment section below. If you'd like to talk to somebody on the Life 180 team, go down in the link in the description below, set up a clarity call with the Life 180 rep, and that's it. Until next video, have a blessed, inspirational day. We'll talk soon. See ya.